You've been sold a dream, a pretty pitch deck, a great presentation, and overly optimistic projections for above average returns. But what if the dream has all the makings of a potential nightmare? In this video, I'm going to share 3 critical mistakes most passive investors make when investing in apartment syndication, and exactly how to avoid them. But before we jump in, don't forget to subscribe and hit that like button. Here's the cold, hard truth. Most passive investors in apartment deals don't fully understand the potential risks that are involved. You think you're buying a solid, stable building, but what you're really buying is a business. A business you know next to nothing about, run by people you've never really checked out. And this isn't just about making a little less money than you had hoped for. This is about watching a huge chunk of your hard-earned capital vanish in a deal that was broken from the start. It's about having your money locked up for 5, maybe 7 years in a failing project, pushing your goal of financial freedom further and further away. I know how it goes. A slick marketing package lands in your inbox. It's got gorgeous photos of a sunny apartment complex and projections that look almost too good to be true. 15, 18, 20% average returns. It feels exciting and exclusive. So you jump on a recorded webinar with a great sales pitch, the presenter answers a few basic questions, and you get swept up in the fear of missing out. So you wire $25, $50, even $100,000, feeling like a genius investor. But behind those glossy pages and big promises could be a much darker reality. Operators who might not have your best interests at heart. Rookies learning on your dime. And business plans built on pure fantasy instead of a solid strategy. You're trusting a sponsor with a multi-million-dollar business and a chunk of your hard-earned money. It's critical that you understand the risks involved so you can make an informed investment decision. But what if you could confidently tell a great deal from one that was built on a poor foundation? What if you had a simple framework to quickly spot red flags that most passive investors miss? Today, I'm breaking down 3 critical mistakes that plague many passive investors. And more importantly, I'm giving you the exact questions and tools that you need to vet a deal and its sponsor like a pro, so you can invest with confidence and mitigate your risk. Mistake number 1, you fall for the property, not the pilot. One of the biggest mistakes you can make is focusing on the property instead of the person flying the plane. There's a saying in this business: you bet on the jockey, not the horse. A great sponsor can take a mediocre deal and make it a winner, but a bad sponsor can drive even a great deal straight into the ground. Don't get mesmerized by the asset or its projected returns. The Proforma, that's that fancy spreadsheet with all the financial projections, might promise an 8% cash return and it'll double your money in 3 years. Remember, those numbers are just a story. They're projections. In the financial world, Proforma refers to statements that are based on hypothetical scenarios. The person who has to make that story come true is the sponsor. Their integrity, their experience, and their track record are way more important than the building itself. An inexperienced sponsor might not have the right contacts to manage the property well. They might not know how to adapt the business plan based on changing market conditions. Or they might not have adequately capitalized the project. And if a sponsor is not transparent when things are good, they're going to go MIA when things go bad. So how do you vet the jockey? Here are some of the non-negotiable questions that every passive investor should ask. First, how many deals have you or your team taken full cycle? Full cycle means they bought the property, executed the business plan, and successfully sold it, returning capital to investors. Plenty of sponsors have bought properties. Far fewer have successfully sold them. An exit is the ultimate proof that they know what they're doing. Second, can you show me the original projections and the final results for all of your past deals, especially the ones that didn't go well? A confident, honest sponsor will have no problem showing you their entire history, warts and all. Be very suspicious of sponsors who only cherry-pick their greatest hits. You can learn more about a captain by how they navigate a storm than how they sail on a calm day. And keep in mind that most deals don't go exactly according to plan, and that's okay. You want to know how a sponsor operates when things get tough. How do they handle adversity? And do they have the skill to manage through it? Be wary of a sponsor who says nothing has ever gone wrong. Third, looking at your track record, how much of your success was your strategy and how much was just good market timing? This is a killer question that will immediately show you know what you're talking about. Ask what they projected the property's income to be versus what it actually was. This tells you if they made the property more valuable through smarter management or if they just got lucky because the whole market went up and they sold for a higher price. Relying on luck is not a strategy. And finally, how much of your own cash are you putting into this deal? This question is all about alignment. If the sponsor has a significant amount of their own money on the line right alongside yours, they're going to fight tooth and nail to protect the investment. If they're only putting in a tiny token amount, or worse, none at all, your money is way more at risk than theirs. Mistake number 2, you trust the Proforma blindly. This second huge mistake is treating the sponsor's financial projections like they're gospel. Let's be clear, the Proforma is a marketing document. There's a reason the pitch decks have legal disclaimers. It's a sales tool designed to look as juicy as possible. And in today's market, overly optimistic projections are a massive red flag. Remember that these projections are built on a whole stack of assumptions. Assumptions about rent growth, about vacancy, about exit cap rates, and more. The market in 2025 is nothing like the market in 2021. Interest rates are higher, and there's a lot of uncertainty in the economy. The era of easy money and growth at all cost assumptions is over. Any sponsor still projecting huge immediate rent hikes might be clueless or worse, dishonest. Your job is to stress test these assumptions, and you don't need to be a Wall Street analyst to do it. You just need to ask, what if? Start with the income. If the sponsor is projecting 5% rent growth year after year, ask them, what's the actual rent growth in this specific neighborhood for this type of building over the last 12 months? Then follow up. What if the rent growth is only 2% or even flat? Show me how the numbers change. A good sponsor should have already tested these numbers and have answers to these questions. Next, vacancy. Projections love to assume a tiny 5% vacancy. But what if a big local employer moves out and vacancy jumps to 10, 12, 15% for the year? Does the deal still work? Is there enough cash in reserve to pay the mortgage and keep the lights on? Ask them what the break-even occupancy is for the project. Then ask them about the assumptions. Ask for the property's financial statements from the last year, what's called the trailing 12 or the T12. Some sponsors will include these docs in the investor portal for your review. If they're not readily available, ask for them. Compare the sponsor's projected expenses found in the Proforma to what was actually being spent. Are they claiming they'll magically slash maintenance costs by 30%? If so, how? They need a specific, believable plan. And finally, the exit. The exit cap rate is one of the most important and most manipulated assumptions. It's just a number that determines the property's sale price. And it's a reflection of what investors are willing to pay for the property based on the income that it generates. Remember, there's an inverse relationship between cap rate and price. The lower the cap rate, the higher the price, and vice versa. Sponsors love to assume they're going to sell at a lower cap rate than they bought it for, which means they'll sell at a higher price. It's really just an assumption that the market will be even hotter in the future when they go to sell. And it's important to understand that even small changes in the exit cap rate can significantly affect the future price. A conservative, trustworthy sponsor will usually assume the cap rate to be the same or even a little bit higher when they sell. Ask them to justify the number. And if they can't give you a data-backed answer, that's a red flag. Mistake number 3, you don't understand the fees and the structure. This third mistake is the most dangerous because it's hidden in plain sight, buried in a lengthy legal document that most investors never actually read. It's failing to understand how the deal is structured, and more importantly, how the sponsor is getting paid. When you invest, you get a document called a Private Placement Memorandum, or a PPM. It's dense, boring, loaded with legal jargon, and it's really tempting to just sign it. Don't. Inside that document are the real rules of the game. Sponsors get paid through fees and profit sharing. There's usually an acquisition fee for buying the building, an asset management fee for overseeing it, and a disposition fee for selling it. These are all standard, but you need to know the percentages. Is it a 1% fee or a 5% fee? The difference adds up and can be a huge drag on your returns. But the most critical piece is the profit waterfall. This dictates how profits are split between you, the investor, and the sponsor. Most deals will also have a preferred return. This means that if there is cash to distribute from the partnership, you, the investor, get paid first, up to a certain percentage, say 7% a year, before the sponsor gets a share of the profits. This sounds great, but you still have to dig deeper. Is the preferred return cumulative? This is key. It means if you only get 4% one year, the 3% they owe you carries over to the next. If it's not cumulative, that unpaid portion is gone forever. You should always insist on a cumulative preferred return. After you get your preferred return, the rest of the profit is split. This is the waterfall. A common split is 70-30. 70% to passive investors, 30% to the sponsor. But watch out for complex structures that give the sponsor a massive chunk of the profits if the deal goes really well. You want a structure that feels fair in all scenarios. The goal is ultimately alignment. You do want the sponsor to get rich when you get rich, not before you do. Don't ever be afraid to ask the sponsor to walk through the entire fee and waterfall structure in plain English. If they get defensive or try to overcomplicate it, that's a huge warning sign. Look, investing in apartments can absolutely be a powerful way to build real, long-term, hassle-free wealth. It's the reason I've invested in over 1,000 apartment units myself. The demand for rental housing is not going away anytime soon, and for disciplined investors, the current market is creating some really incredible opportunities. But it is not a passive sport. It requires you to be an active watchdog of your own money. Stop blindly trusting the pretty spreadsheets. Stop falling for a beautiful building and ignoring the person that's running it. And stop signing documents that you don't understand. The power in this game is with you, the investor, because you have the capital that sponsors need. Don't let anyone rush you with FOMO. The best deal is not the one with the highest projections. It's the one with the best sponsor and the most conservative, achievable business plan. By avoiding these 3 key mistakes, you can step into apartment investing with confidence and build the financial security that you're after. Do your homework, ask the tough questions, and never ever let anyone be more careful with your money than you are. I know we covered a lot of ground and it's probably a lot to take in. Trying to remember all these questions when you're looking at an exciting new deal can be really tough. That's why I put all this into a simple 1-page checklist. It's called the 30 Essential Questions to Ask Before You Passively Invest. This free guide gives you a comprehensive checklist of the questions you need to ask, from vetting the sponsor to stress testing the deal, so you can mitigate risk and invest with confidence. You can download it completely free right now using the link in the description below. If you got value from this video, I'd appreciate it if you could subscribe and hit that like button so we can reach more people in the algorithm and help others on their journey to financial freedom. I'd also love to hear your thoughts or answer any questions you have, so make sure to leave them in the comments below. See you in the next one.